Welcome back to the deep dive. For most of us, money is already pretty digital, right? We tap our phones, we click buy, funds move around easy. But what if that digital money was, well, even more digital, living on a blockchain maybe? Instant global reach, but still promising the solid stability of, say, a dollar bill. That's the whole idea behind stablecoins, and honestly, they're becoming a really big deal in our digital economy. But, with all this fast innovation, you need clarity, you need trust. And that's exactly what we're diving into today. We're taking a really close look at a proposed law that could basically reshape digital money in the US. It's called the Guiding and Establishing National Innovation for US Stablecoins Act. Quite a mouthful, so everyone calls it the Genius Act. And this isn't just some dry legal document. Think of it more like a blueprint. It's trying to bring clarity and stability to this fast-moving corner of finance specifically, payment stablecoins. So why talk about this now? Well, stablecoins have just exploded in popularity. They're trying to fix a big crypto problem. Volatility, prices jumping all over the place. By pegging their value to something stable, usually the good old US dollar, they act like digital cash. Great for payments, sending money, navigating the crypto world. But that growth, it brings questions. Are they safe? Is the backing really there? Who's actually watching over this stuff? That's why understanding the Genius Act is so critical for you, whether you're deep into crypto, run a business, or just curious about where money's heading. Our mission today: cut through the jargon, pull out the key stuff, get to the heart of what this act proposes for creating, using, and overseeing payment stablecoins, and ultimately what it means for your financial world. Let's get into it.
It's definitely a crucial conversation. The whole digital asset space has felt a bit like the Wild West, regulation-wise. The Genius Act is, well, it's a serious attempt to bring real structure and certainty, especially for these payment stablecoins. Understanding this framework is essential because, honestly, it directly impacts how securely, how reliably you might be using digital money down the road.
Okay, let's unpack this then. Before we get into the weeds of the regulations, we need to kind of agree on the language, right? This act defines some really crucial terms. They're going to pop up again and again, because if we're fuzzy on the terms, the rules won't make much sense.
Exactly. And these aren't just, technical details. They carry real legal weight, operational implications. They draw sharp lines around what the law intends to cover, and maybe just as importantly, what it specifically leaves out. Hashtag tag JEDOA, defining digital asset.
Okay, so first up, this big umbrella term, digital asset. Now, the start of our show today, the payment stablecoin, fits under this umbrella. But before we zoom in on stablecoins, can you just ground us? What makes something a digital asset according to this act?
Sure. It's really the starting point. The Act defines a digital asset pretty broadly. It's basically any digital representation of value that's recorded on a cryptographically secured distributed ledger. So think blockchain tech. That's the core. This matters because it tells us right away we're dealing with a specific kind of digital thing, one that uses DLT distributed ledger technology for its, unique features like immutability, transparency. It's the big category. It covers everything from Bitcoin to the stablecoins we're focusing on. Hashtag tag B, unpacking payment stablecoin.
Got it. Digital asset, big category. Blockchain involved. Okay, so within that, how does the act carve out our main focus? The payment stablecoin. What makes it special?
Right, this is where the Genius Act gets really specific. Clarity here is, well, everything. A payment stablecoin is defined as a digital asset that's mainly designed for, payments or settlement, making transactions. But here's the really important part, the kicker. Its issuer must be legally obligated to convert it or redeem it for a fixed amount of monetary value, like $1. And critically, it has to represent that value, or at least create a reasonable expectation that it will hold its value steady against that fixed amount. So if you're holding one, you basically have a legal right to get your dollar back, and you expect it to stay worth $1. That's the core promise. Now, what's really interesting, and maybe a bit surprising, is what the Act says it isn't. A payment stablecoin, under this definition. It's not a national currency, so not like actual dollar bills or coins, or even a potential central bank digital currency, a CBDC, if the US ever made one. It's also not a deposit. Even if that deposit happens to be recorded using blockchain tech, that's a really vital distinction. It keeps stablecoins separate from your normal bank account and makes it clear they aren't replacing government money.
Okay, that's a huge clarification. Setting it apart from traditional banking, potential CBDCs. But the distinction that seems to cause the most buzz is how it treats stablecoins compared to, say, securities law.
You're absolutely right. That is probably the biggest point of clarity the Act tries to achieve. It states pretty explicitly that a payment stablecoin, if it's issued by one of these permitted issuers we'll talk about, is not a security. This aims to cut through literally years of regulatory fog that surrounded other digital assets. The insight here, I think, is the Act's deliberate balancing act. It wants to create a clear, maybe lower friction path for stablecoin innovation by taking that securities label off the table. That label can bring heavy compliance costs, right? But then it compensates. It puts in place this rigorous, almost bank-like regulatory framework. It's designed to protect consumers through other means like super strict reserve rules, transparency mandates. It's kind of a trade-off. Maybe less investor protection under securities law, but aiming for robust stability and operational safety under financial regulation. Hashtag KOEC, digital asset service provider, the intermediaries.
Okay, so if these payment stablecoins aren't securities, not deposits, who are the companies actually getting them to us, making them available? The Act also defines these digital asset service providers. Sounds like the middlemen.
Yes, exactly. They're the essential intermediaries in the ecosystem. The Act defines a digital asset service provider as basically anyone who, for money, does a few things. Exchanges digital assets for cash or other digital assets, transfers them, holds them for you like a custodian, or gets involved in the financial services around issuing them in the U.S. So think of your crypto exchanges, the wallet providers you might use, the companies that help you buy or sell stablecoins. They're the sort of visible, often centralized points where you interact with these assets.
That makes sense. It targets those recognizable players. It's kind of like the difference between, say, your bank, the service provider, and the internet itself, the underlying protocol. The Act seems to draw clear lines there because it also leaves some things out, right?
Precisely. And what it excludes is just as important for understanding the scope. The definition specifically doesn't cover the distributed ledger protocols themselves. So the actual blockchain network or the smart contracts running on it, not service providers under this definition. It also excludes people who just develop or operate these protocols or build self-custody software interfaces, the tools you might use to hold your own keys. Transaction validators, so the miners or stakers confirming transactions, and folks who just provide liquidity for peer-to-peer trading pools are also out. This distinction is crucial. It suggests the Act aims to regulate the identifiable companies providing services on top of the tech, rather than trying to regulate the often decentralized, maybe permissionless infrastructure itself that can be much harder to pin down and supervise. So the focus is clearly on regulating the human-run services, not necessarily the code itself. Seems pragmatic, maybe, but it does make you wonder how it adapts if those lines between service and protocol get blurrier in the future. Hashtag D, permitted payment stablecoin issuer, the gatekeepers.
And then the big one, the permitted payment stablecoin issuer. These are the official gatekeepers, right? The only ones who actually get the green light to create these stablecoins under the Act.
That's exactly right. This is essentially the approved list, the white list for stablecoin issuance in the U.S. To be a permitted payment stablecoin issuer, you have to be a U.S. entity, first off. And you need to fit into one of three specific, tightly regulated categories. One, you could be a subsidiary of an insured depository institution. Think a bank that's gotten specific approval for this. Two, you could be what they call a federal qualified payment stablecoin issuer. This could be a non-bank company or maybe an uninsured national bank or even a federal branch, but you need approval from the Office of the Comptroller of the Currency, the OCC. Or three, you could be a state-qualified payment stablecoin issuer operating under a state-level regime that meets certain standards, which we'll get into. So it sets up this highly regulated entry point. It strongly links stablecoin issuance to existing financial regulatory structures. It's not meant to be just anyone setting up shop. These are expected to be serious supervised players. Hashtag E, key regulatory bodies defined.
Okay, so we're definitely talking about a highly regulated space here. And naturally, that means involving a lot of the usual suspects, the federal agencies. The Act mentions key regulators we'll hear about: the Fed Board, the OCC, the FDIC, the NCUA for credit unions. But there's also a specific new committee created, isn't there?
Yes, and it's designed to be quite powerful. The Stablecoin Certification Review Committee. This group is chaired by the Secretary of the Treasury. Its members include the chair of the Federal Reserve Board, or specifically the vice chair for supervision, and the chair of the FDIC. It's set up to be driven by consensus. It needs a 2/3 vote to take action unless they have unanimous written consent. This structure suggests a strong desire for broad agreement among the top financial regulators on the really critical decisions, especially when it comes to certifying those state regulatory regimes we mentioned. It ensures major calls have buy-in from the key players.
Okay, so we've laid the groundwork. We know the key terms. But what does this all mean for you, the person maybe holding or using a stablecoin? We know what a payment stablecoin is supposed to be and who gets to issue them. Now let's dig into the really critical rules. How are they issued? What hoops do issuers have to jump through to ensure these things are actually stable and safe? This is where, the rubber meets the road, where definitions become actual rules designed to build trust.
Absolutely. This section is really the regulatory backbone of the entire Act. It's designed specifically to build confidence in payment stablecoins. How? By tackling those fundamental worries head-on. Their backing, their transparency, their operational soundness. These requirements aim to build a really robust, trustworthy system right from the start, borrowing a lot from the traditional financial system we already rely on. So first things first, the Act establishes what's basically an issuance monopoly. Section 3A is crystal clear. It makes it unlawful for any person other than one of those permitted payment stablecoin issuers to actually issue a payment stablecoin in the United States. That's a powerful, unambiguous starting point.
Wow. So that effectively shuts the door on unregulated issuance here in the U.S. It aims to bring all the significant stablecoin activity under this strict supervision. That feels like a massive shift from the sort of Wild West stories we often hear about crypto. A real push to ensure only trusted players can mint these digital dollars.
Totally. The goal is clearly to eliminate the risk we've seen with some, let's say, opaque or underbacked stablecoin projects in the past. And the Act puts teeth behind this. Knowingly violating this rule, you could face up to a $1 million fine, 5 years in prison, or both. Serious stuff. Now, the Treasury Secretary does get a little wiggle room. They can issue very narrow safe harbors for de minimis transactions, meaning really small, insignificant amounts or in truly unusual and exigent circumstances. So some flexibility for rare specific cases, but the main rule is strict. And importantly, the Act intends to reach beyond U.S. borders. It aims to apply globally if the activity involves offering or selling these stablecoins to people in the U.S. This signals a clear intent to protect U.S. consumers no matter where the stablecoin originates. And here's a critical consequence for stablecoins not issued by permitted issuers. They basically get locked out of the legitimate financial system. They can't be treated as cash or cash equivalents for accounting. Financial institutions can't use them for margin or collateral. They can't be used as settlement assets in wholesale payments.
This really restricts their use and legitimacy, effectively building a wall around the unregulated ones. However, and this is really important for individual users, the Act also carves out some crucial exemptions. It makes clear that these issuance rules don't apply to direct peer-to-peer transfers. So, you sending stablecoins directly to a friend, that's okay. Also exempt. Transferring funds between your own accounts, even across borders if it's the same parent company, and using self-custody wallet software or hardware to hold your own assets. So the focus is squarely on regulating the issuers, the institutions creating these things, not penalizing individuals for holding their own crypto or making direct P2P payments. It tries to preserve some of that decentralized spirit for personal use while bringing the big players under regulation.
Okay, now this is where it gets really interesting for anyone worried about the stable part of stablecoins, right? This isn't just a suggestion. It sounds like a strict mandate about what actually backs these digital dollars. Because if it's not backed, what is it really worth?
Precisely. This is the absolute cornerstone of trust in the whole system. Permitted issuers must, it's mandatory, maintain identifiable reserves backing their outstanding stablecoins on at least a one-to-one basis. That's non-negotiable. For every single digital dollar they issue, there has to be a real dollar or a dollar equivalent asset held securely in reserve. The goal is instant, reliable redemption for holders. And the Act gets incredibly specific, really prescriptive, about what counts as an eligible reserved asset. It's intentionally narrow. The focus is extreme safety and extreme liquidity, very much like how the safest money market funds operate. We're talking about things like actual U.S. coins and currency physical cash or money held directly in an account at a Federal Reserve Bank, so cash or its closest equivalent. Also, demand deposits or insured shares at other insured banks or credit unions. This allows for some diversification, so reserves aren't all piled up in one place. Then you have U.S. Treasury bills, notes, or bonds, but only those with 93 days or less left until they mature, or ones that were issued with that super short maturity. Ultra-safe, easily sellable government debt.
Overnight repurchase agreements repos, but only if they're backed by those short-term T-bills. And similarly, overnight reverse repos collateralized by treasuries, with specific safety features like central clearing or dealing only with credit-worthy parties. These are basically very secure, very short-term lending deals used for liquidity. You can also hold shares in government money market funds, but only if those funds themselves invest exclusively in the assets I just listed. And finally, the regulators can approve other similarly liquid assets issued by the federal government. It's a tight list.
So it's not just any safe asset. It's like the absolute safest and most liquid assets out there. What's really interesting, though, is that mention of tokenized forms of these reserves. It feels like the Act is nodding to the digital future while still demanding that old school, rock solid backing.
Absolutely. It's a clever blend, right?
Yeah.
Using traditional financial prudence, but applying it in this new digital context. It ensures the digital part doesn't weaken the stable part.
Yeah.
And to really hammer home the safety, the Act includes a strong ban on something called rehypothecation.
Rehypothecation. Okay, that's a finance buzzword. What does that actually mean for someone holding a stablecoin? Why should they care? It's crucial. It means the issuer cannot take those reserve assets and pledge them, or lend them out, or reuse them in any way for their own benefit or to get leverage. Those reserves are ring-fenced. They are held strictly one-to-one for the sole purpose of meeting redemptions. Think of it like money held in trust. It ensures the funds are actually there when you ask for your dollar back. There are a couple of very narrow, tightly controlled exceptions, like for managing margin in those permitted repo deals, or maybe facilitating redemption smoothly, but the core principle is clear. Those reserves are sacred, they're segregated, they're not to be messed with. This prevents issuers from taking risks with the backing assets, which, frankly, has been a source of major blowups in some past crypto projects. #C, transparency and accountability, Section 4A, 1B, C3. Okay, so beyond just having the right reserves, the Act demands significant transparency and accountability. It really puts the burden on the issuers to be totally open with the public about what they're doing. Yeah, because what good are rules if nobody can actually check if they're being followed, right? Transparency is how you build that trust.
Exactly right. So issuers have to publicly disclose their redemption policy, clearly, conspicuously, laying out the procedures for timely redemption. And get this, any discretionary limits on redemptions, they can only be imposed by the regulators, not just decided by the issuer if they feel like it. That's a huge consumer protection piece. Also, all the fees for buying, fees for redeeming, they all have to be publicly disclosed in plain language. And if they change fees, they need to give you 7 days notice beforehand, no surprise charges. Furthermore, and this is really critical, for verification issuers have to publish monthly, right on their website, the detailed composition of their reserves. This isn't just a total number. It has to include the total amount of stablecoins they have outstanding, and then a breakdown of the reserves, the amount in each category, the type of assets, the average tenor, like how long until those T-bills mature, and even the geographic location where each category of reserves is held in custody. That level of detail allows for real public scrutiny. But it begs the question, how do we know this information is accurate? The Act tackles that directly. It requires that the information in these monthly reports has to be examined monthly by a registered public accounting firm, an outside auditor looking at it every month. On top of that, the CEO and the CFO of the issuing company have to personally submit a monthly certification to their main regulator, attesting that the report is accurate. And if they knowingly submit a false certification, we're talking severe criminal penalties, similar to Sarbanes-Oxley. That puts real personal liability on the executives, emphasizing how seriously this transparency is taken. It's a pretty comprehensive approach to making sure the claims match reality. #G, capital, liquidity, and risk management. Section 4A4. The Act doesn't just stop at reserves and transparency, though. It also sets out comprehensive requirements for capital, liquidity, and managing risk, very much like what you'd expect from a traditional, well-regulated bank.
Okay, so it's not just about having enough cash, like in the vault for redemptions. It's also about ensuring the whole company, the whole operation, is financially sound and can handle unexpected problems.
Precisely. The regulators, whether federal or state, are required to issue specific rules covering. First, capital requirements. These need to be tailored to the issuer's specific business model and risk profile. Enough capital to ensure they can cover ongoing operational costs and absorb potential losses, maybe even including extra capital buffers for safety. Second, liquidity standards. These will naturally be tied closely to that 1.1 reserve requirement, making sure the issuer can meet redemption demands quickly, even if there's a sudden rush. Third, reserve asset diversification. This includes setting limits on how much can be deposited with a single bank and rules for managing interest rate risk, like if the value of those short-term treasuries changes slightly. And fourth, operational compliance and IT risk. These are more principles-based rules covering everything from cybersecurity readiness to making sure they comply with the Bank Secrecy Act and economic sanctions. Now, regulators get what's called tailoring authority. This means they can adjust these requirements based on how big the issuer is, its specific business model, its risk profile, how complex it is.
This avoids a situation where a small, simple issuer gets crushed by rules designed for a massive global operation. And, importantly, If the issuer is part of a larger company, the capital required specifically for the stablecoin part can't be more than what that issuer itself needs under these rules. It prevents regulators from piling on excessive capital demands just because it's part of a bigger group. It's about making the rules fit the situation appropriate, not necessarily excessive. ###EE. Treating stablecoin issuers as financial institutions, Section 4A5.
Okay, this feels like a really big shift in perspective. It basically pulls these stablecoin issuers fully into the existing regulatory world designed to fight financial crime. They're not just treated like tech companies anymore. In the eyes of the law, they are financial institutions.
Indeed, that's a crucial designation. Permitted payment stablecoin issuers are explicitly treated as financial institutions for the purposes of the Bank Secrecy Act, the BSA. What that means practically is they become subject to all the federal laws that apply to U.S. banks and other financial firms concerning things like economic sanctions, preventing money laundering, identifying customers, and doing due diligence. This translates into needing several specific mandatory programs. They need an effective anti-money laundering (AML) program, complete with risk assessments, and a designated compliance officer. They need robust record keeping. They need systems for monitoring transactions and reporting suspicious activity, SARS. And critically, they need the technical capabilities built into their systems to actually block, freeze, or reject transactions deemed impermissible under the law. They also must have an effective customer identification program, what most people know as Know Your Customer, or KYC. And of course, an effective program for complying with economic sanctions, making sure they don't facilitate deals for sanctioned individuals or countries. The Treasury Secretary is specifically tasked with creating rules tailored to implement these BSA requirements for stablecoin issuers, acknowledging that the digital nature might require some specific approaches.
So they're not just digital money issuers, they're effectively operating like mini banks under really strict supervision, and they've got to have the actual tech baked in to enforce those rules. It sounds a bit like upgrading, say, a simple toll booth to a high-tech border crossing with security scanners and automated gates, doesn't it?
That's a pretty good analogy, yeah. And it goes even further. The Treasury is directed to coordinate with issuers to make sure they can effectively block stablecoins linked to sanctioned foreign persons. Issuers must have the technological capability to comply with any lawful order they receive, whether that's to seize assets, freeze them, maybe even burn tokens, digitally destroy them, or just prevent them from being transferred. This is a powerful mandate for technical compliance. It recognizes that in this digital world, compliance isn't just policy. It's often embedded directly in the code and the system's functionality. This capability is seen as absolutely paramount for national security and fighting illicit finance. #F Activity Limitations and Prohibition, Section 4A, 7, 8, 9, 11. The Act also draws some clear lines around what these issuers can and cannot do, activity-wise. The idea is to keep them focused on their main job, issuing stablecoins safely, and prevent potential conflicts of interest or excessive risk-taking.
Right, so they can't just branch out and do anything they want. There are specific guardrails in place.
Exactly. Their permitted activities are pretty narrowly defined. Issuing the stablecoins, redeeming them, managing those all-important reserves, providing custody or safekeeping for the stablecoins, reserves, or private keys, and any activities that directly support these core functions. Now, they can engage in other authorized stablecoin or digital asset service provider activities, but there's a key condition. The claims of stablecoin holders must rank senior to any non-stablecoin creditors when it comes to those reserve assets. Basically, stablecoin holders always have first dibs on the reserves. That's paramount. A really significant prohibition is on tying. Issuers can't force customers to buy other products or services from them or their affiliates just to get the stablecoin service. They also can't make you agree not to use a competitor service. This is standard anti-competitive practice prevention, aiming for a fair market. The Federal Reserve Board can grant exceptions, but the general rule is no tying. There's also a ban on deceptive names.
Issuers can't use words like United States, USG, or otherwise imply that they're stablecoins issued by the government, guaranteed by the government, or as legal tender. This is purely to avoid confusion and make sure people understand these are privately issued assets, not official government money. Although using abbreviations related to the pegged currency like USD for a dollar-pegged coin is explicitly allowed. And here's a point that's quite fascinating and a really critical distinction from traditional banking. Permitted issuers, and even foreign ones operating under these rules, cannot pay interest or yield. That means no paying you interest just for holding the stablecoin, whether it's in cash, more tokens, or any other kind of reward, solely for holding, using, or retaining it. This is a major departure from bank deposits or many other financial tools. It clearly signals the intent for these payment stablecoins to function primarily as a medium of exchange, like digital cash for payments, rather than as an investment vehicle where you expect a return just for parking your money. It reinforces their role as a payment rail, not a savings account. Hashtag tag check audits and financial statements.
For the really big players specifically, issuers with over $50 billion in outstanding stablecoins who aren't already subject to SEC reporting rules, the Act layers on additional audit and financial statement requirements.
Ah, okay. So the bigger you get, the more intense the scrutiny. That seems like a pretty standard, sensible approach to managing potential systemic risk, doesn't it?
Absolutely. It's tiered regulation. These larger issuers have to prepare annual financial statements according to GAAP, generally accepted accounting principles. Just like public companies, these statements must include detailed disclosures about any transactions with related parties. And importantly, these financial statements have to be audited by a registered public accounting firm, following the rigorous standards set by the PCAOB, the Public Company Accounting Oversight Board. That audit covers things like auditor independence, the company's internal controls over financial reporting, and those related party transactions. It ensures a very high degree of financial transparency for these systemically significant players. And these audited statements, they have to be made publicly available on the issuer's website and also submitted directly to their primary federal regulator. It's about bringing bank-level financial scrutiny where it matters most. Hashtag LEG non-financial public companies and foreign companies. Section 4A12. Lastly, in this core section, the Act specifically addresses concerns about large tech companies or other big non-financial businesses getting into the stablecoin game.
Right. This sounds like it's aimed at preventing, say, a massive online retailer or social media platform from issuing its own currency and then using all that transaction data to dominate other markets, or maybe creating new systemic risks.
You've hit the nail right on the head. The Act puts up a pretty high wall here. Public companies that are not predominantly engaged in financial activities, so big tech, big retail, etc., and their subsidiaries, are generally prohibited from issuing payment stablecoins. There's an exception, but it requires the Stablecoin Certification Review Committee, that group with Treasury, Fed, FDIC, to unanimously find that their issuance poses no material risk to the U.S. banking system, overall financial stability, or the Deposit Insurance Fund. That unanimous requirement sets an extremely high bar. It signals significant caution about letting non-financial giants into this space. And even if somehow such a company got approval, they'd face strict limitations. They'd have to comply with tight data use restrictions. Any non-public personal information they get from stablecoin transactions couldn't be used for targeted advertising, sold to third parties, or shared with non-affiliates without explicit consumer consent, unless needed for legal or regulatory reasons. They also have to follow those anti-tying prohibitions we discussed earlier.
And similar rules and prohibitions apply to non-U.S. companies that aren't primarily financial firms. The clear goal here is to kind of ring-fence stablecoin operations, mitigate potential systemic risks from these huge conglomerates, and prevent tech giants from leveraging financial services to unfairly amplify their data advantages. It's a fairly strong move to maintain a separation between banking and commerce.
Okay, so we know the rules issuers have to follow. But wanting to follow the rules isn't enough, right? If you want to become a permitted payment stablecoin issuer, you first have to apply and get official approval. And it sounds like this isn't just a rubber stamp process. It's a pretty rigorous entry exam. Let's look at how that works and then how they keep an eye on things afterwards.
Exactly. This section really lays out the how of getting into this regulated stablecoin ecosystem, and then the who and how of ongoing monitoring. The emphasis throughout is clearly on safety and soundness. Applying those tried and tested banking principles to these new digital assets to make sure they're reliable right from the start and stay that way. Hashtag A, application process, section 5A. So the application process itself is clearly defined. Who applies depends on the category. Insured depository institutions apply for their subsidiaries. Non-bank entities, federal branches, or uninsured national banks apply if they want to become one of those federal qualified issuers. They submit their application to their primary federal payment stablecoin regulator, usually the Fed or the OCC. These regulators are then mandated to receive, review, and consider these applications. They have to set up a framework for licensing, regulation, examination, and supervision that really prioritizes the safety and soundness of these potential issuers. And a really key point, regulators must evaluate and make a decision on every application they receive that's substantially complete.
They can't just let applications sit in limbo indefinitely. It prevents regulatory foot dragging being a blocker. Hashtag FTB. Factors for evaluation.
Section 5C.
Right. So what exactly are these regulators looking at when they review an application? What does safe and sound actually mean in this context? What gets you approved?
They consider several key factors during this evaluation, and it's pretty thorough. First, financial health. They look hard at the applicant's or its subsidiary's financial condition. Do they have the resources to actually meet all those tough requirements back in Section 4? The reserves, the capital, the risk management capabilities we talked about. Second, leadership integrity. This is huge. None of the proposed officers or directors could have been convicted of certain serious felonies, things like insider trading, embezzlement, major cybercrime, money laundering, terrorism financing, or financial fraud. Basically, are the leaders trustworthy? Third, competence and compliance. They scrutinize the competence, the experience, and the overall integrity of the officers, directors, and principal shareholders. What's their track record? Have they complied with regulations in the past? Can they actually deliver on their commitments? Fourth, redemption policy. Does the plan for how users can redeem their stablecoins meet the Act's standards? Is it clear, timely, transparent? And fifth, other safety and soundness factors. Regulators have a catch-all here.
They can consider any other factors they deem necessary to ensure the issuer will operate safely and soundly. Now, what's really noteworthy here, and it's kind of a nod to the crypto world's origins, is Section 5D2. It explicitly says that the fact that a payment stablecoin might be issued on an open, public, or decentralized network cannot by itself be a valid reason to deny an application. That's a pretty crucial statement from Congress. It acknowledges that the underlying technology being decentralized doesn't automatically make an issuer unsafe as long as they can meet all the other stringent requirements. But it definitely raises an important question, right? How will regulators effectively balance the unique nature of these decentralized networks with the traditional oversight tools they're used to? It suggests they'll need an adaptive approach, maybe new supervisory techniques. But the Act clearly signals the tech itself isn't a deal breaker. #C. Timing and denial procedures, Section 5D. The Act also tries to bring some certainty and fairness to the process by setting clear timelines and procedures for denials.
Regulators are required to make a decision within 120 days after they receive a substantially complete application. And they also have to let the applicant know within 30 days if the application is complete, or if not, what specific additional information is needed. This gives clarity right from the start.
Okay, so no more getting stuck in regulatory purgatory for years on end. There's actually a ticking clock for the regulators.
Exactly. And a denial isn't just a no. It can only happen if the regulator determines the proposed activities would be unsafe or unsound, based specifically on those evaluation factors we just discussed. And crucially, if they do deny an application, they have to provide a written notice explaining why with specificity. It has to detail their findings and, importantly, offer actionable recommendations on how the applicant could address the shortcomings. This gives applicants a clear roadmap to understand the issues and potentially fix them rather than just hitting a brick wall. Applicants also have appeal rights. If denied, they have 30 days to request a hearing, either written or oral, to meet their case. A final decision must then come within 60 days of that hearing. And here's a really significant clause, designed to push regulators to act promptly. If a regulator fails to make a decision on a complete application within that 120-day window, the application is deemed approved.
Wow, deemed approved. That's strong.
It is. It's a powerful incentive against bureaucratic delay, potentially stifling innovation. And of course, getting denied doesn't mean you can never try again. You can always reapply once you've addressed the issues. So yeah, the combination of the deemed approved clause, the specific denial reasons, and the appeal process really aims to prevent regulatory bottlenecks while ensuring due process. #DIND. Ongoing supervision and enforcement, Section 6. Okay, so let's say you get approved. That's not the end of the story. There's ongoing supervision and enforcement. Once approved, these permitted issuers, except for the smaller state-qualified ones, under $10 billion, which we'll get to, are subject to continuous supervision by their primary federal regulators. They have to submit regular reports about their financial condition, their risk management systems, their compliance programs, including BSA and sanction stuff, whenever the regulator asks. Regulators will also conduct regular examinations, basically, checkups to assess their operations, look at their financial, operational, and tech risks, and review their internal controls. Now, the Act does include an efficiency mandate. It tells regulators to try and use existing reports where possible, avoid duplication, and consider the burden on the issuers. So, effective oversight, but hopefully not needlessly burdensome.
Right. So it's not like you get your license and then you're left alone. It's a continuous process of monitoring to make sure everything stays compliant and stable.
Absolutely. And if things go wrong, Regulators have a pretty robust enforcement toolkit. They can suspend or even completely revoke an issuer's approval to operate. They can issue cease and desist orders to make them stop specific problematic activities. They can even remove or prohibit individuals associated with the institution, like executives or board members, if they're found to have engaged in willful or reckless violations of the Act, its regulations, or any written agreements with the regulator. And then there are these civil money penalties, the fines. These are designed to be a serious deterrent. First, if someone issues a US dollar payment stablecoin without getting approval, that's up to $100,000 per day, a massive penalty. Second, for general violations, materially breaking the rules of the Act, regulations, or conditions of approval, also up to $100,000 per day. And third, there's an additional penalty, also up to $100,000 per day, specifically for knowing participation in those violations. This targets the individuals who were directly involved and knew what they were doing was wrong. These penalties are substantial.
They send a very clear signal that compliance is expected and enforcement will be serious to maintain the integrity of this regulated system.
Okay, this is interesting. It sounds like the Act doesn't just create one single federal path for becoming an issuer. It actually sets up parallel tracks, allowing for both federal and state-level oversight. That feels like a very American approach, doesn't it? A blend of centralized and more localized regulatory power.
It really is. And what's quite fascinating here is how it explicitly acknowledges the financial regulatory expertise that already exists at the state level. Many states have been quite active in the fintech space. So this dual approach tries to leverage that state experience. But this is critical. It builds in mechanisms to ensure consistency across states and prevent a race to the bottom, where states might compete by offering overly lax rules just to attract business. It recognizes states can be nimble, maybe innovative in their regulation, but insists on a strong federal baseline for safety and soundness. Hashtag A, state-level regulatory regimes. Section 4C. So here's how the state path works. States get the option to set up their own regulatory systems for what the Act calls state-qualified payments stablecoin issuers. But there's a key limitation. This state-level path is primarily for issuers with less than $10 billion in consolidated total outstanding issuance, smaller players essentially. And the absolute core condition is that the state's regulatory regime must be substantially similar to the federal framework laid out in this Act. A state can't just create a super lightweight version.
The Secretary of the Treasury is tasked with setting broad principles through rulemaking to define what substantially similar actually means, ensuring everyone is meeting a common high bar. To make sure states actually meet this standard, their payment stablecoin regulators have to go through a certification process. They need to submit an initial certification and then annual recertifications to that Stablecoin Certification Review Committee we mentioned earlier, Treasury, Fed, FDIC. In these certifications, they basically have to attest, yes, our state regime meets the substantially similar criteria. The committee then reviews these. To get approved, it requires a unanimous determination from all three agencies that the state's rules meet or even exceed the federal standards. High bar. If they deny a certification, they have to provide a written explanation with enough detail so the state knows exactly what needs fixing. It encourages a dialogue. A recertification can only be denied if the state's regime has materially changed and now poses a serious risk. This provides some stability. They can't just pull approval arbitrarily. States get 180 days to fix any identified problems and resubmit.
They can even appeal a final denial to the U.S. Court of Appeals for the D.C. Circuit. Treasury will publish a list of the certified states so everyone knows which state regimes are approved. And there's even a pathway for expedited certification for states that already had robust digital asset or stablecoin regulations in place shortly before this act was passed, acknowledging and rewarding those early movers. Hashtag B. Transition to federal oversight, Section 4D. However, this state-level supervision isn't unlimited. The Act builds in a clear trigger point for shifting to federal oversight. That trigger is size. If a state-qualified payment stablecoin issuer, whether it's a bank subsidiary or a non-bank, grows and exceeds $10 billion in consolidated total outstanding issuance...
Okay. So that's the too big for state supervision alone clause, essentially. Once you hit that $10 billion mark, you automatically attract more federal attention based on the idea that larger operations could pose broader systemic risks.
Exactly right. Once an issuer crosses that $10 billion threshold, they have 360 days, about a year, to do one of two things. Either they transition to the federal regulatory framework. This would then be administered jointly by the relevant state regulator and the primary federal regulator, so dual supervision. Or their other option is to simply stop issuing new payment stablecoins until their total outstanding amount drops back below the $10 billion threshold. So it creates this clear trigger based on size and potential systemic importance, pushing larger players into direct federal oversight. Now, there is a waiver option. The relevant primary federal regulator can choose to permit an issuer that's gone over the $10 billion threshold to remain solely under state supervision. But
They have to consider specific criteria: the issuer's capital levels, its track record from past operations and exams, the experience of the state regulator specifically with stablecoins, and the overall quality of the state's supervisory framework. And there's even something called a presumptive waiver for issuers in states that had those established certified regulatory regimes before this act came along.
In those cases, the federal regulator would need clear and convincing evidence that the waiver criteria aren't met, or that the issuer poses significant safety risks to actually deny the waiver and force the transition. This aims to avoid unnecessary disruption for issuers already operating under competent, proven state supervision, recognizing that some states have genuinely built robust systems. #tag 20-IC, state-level enforcement in exigent circumstances, Section 7E.
Okay, this sounds like a really significant federal safety net, though. It ensures that even if an issuer is primarily state-regulated, the feds can step in if things really hit the fan and financial stability is threatened. It's kind of like a financial break glass in case of emergency clause, giving the federal government ultimate authority when the stakes get really high.
Precisely. It's a backstop power. In what the Act calls unusual and exigent circumstances, the Federal Reserve Board, or the OCC, can take direct enforcement action against a state-qualified payment stablecoin issuer. They could even impose limitations on redemptions, which is a major step. They just need to give the state regulator 48 hours prior notice before acting. The justification for using this power has to be a determination of serious risk to financial safety, soundness, or stability. Any directive issued under this power is subject to administrative review. The Fed Board has 10 days to confirm, change, or cancel it. Otherwise, it expires, and there's also immediate judicial review possible if there's extraordinary cause. So yeah, it provides a critical safeguard for overall systemic stability, ensuring a federal intervention capability even for state-supervised entities if a crisis looms. #D, host state versus home state law, Section 7S. Finally, under this dual system, the Act clarifies which states' laws apply when an issuer operates across state lines, particularly regarding consumer protection. This is vital for smooth interstate business.
The rule is that host state laws, meaning the laws of the state where the customer is, not where the issuer is based, including consumer protection laws, will apply to an out-of-state, state-qualified issuer. And importantly, they apply to the same extent that they already apply to out-of-state, federal qualified issuers. This aims to create a level playing field for consumer protection across the country. So as a consumer, you should have similar protections regardless of whether the stablecoin issuer you're using is based in your state or another one, or whether it's state or federally qualified. If a specific host state law doesn't apply for some reason, then the issuer's home state laws govern that particular issue. And the Act makes it very clear. It does not preempt general state consumer protection laws or common law remedies. States keep their power to protect consumers. The only state laws it does preempt are those specifically governing the chartering or licensing process to become a permitted issuer under this Act. So it standardizes the regulatory home for issuers, but preserves states' roles in consumer protection.
Right. The digital world doesn't really care about borders, does it? And stablecoins can zip around the globe pretty easily. So how does the Genius Act try to manage stablecoins issued outside the U.S.? And how does it ensure they don't become conduits for money laundering or other illicit activities flowing into our financial system?
Yeah, this section is absolutely critical because of that global nature of digital assets. It's trying to strike a balance, right, between needing international cooperation and having a very strong need to protect the U.S. financial system from illicit finance risks. Because as you said, stablecoins can move across jurisdictions instantly, potentially bypassing domestic controls if you're not careful. #A, restrictions on foreign payment stablecoins, Section 3B2, Section 8A. So the Act starts by imposing pretty strict restrictions on foreign-issued payment stablecoins. Digital asset service providers here in the U.S., the exchanges, the platforms are generally prohibited from offering or selling foreign-issued payment stablecoins unless that foreign issuer meets a key test. The foreign issuer must have the technological capability to comply with any lawful order from U.S. authorities, and they must demonstrate they will comply. This is a foundational requirement. It recognizes that with digital assets, compliance often means having specific technical controls built in, like the ability to freeze or block funds if ordered. Building on that, the Secretary of the Treasury gets significant power.
Treasuries can actually designate specific foreign issuers as non-compliant. And if they do, they can prohibit U.S. digital asset service providers from facilitating even secondary trading of that stablecoin within the U.S. This designation would happen after a 30-day notice period and publication in the Federal Register. It's a powerful tool to try and curb the influence of non-compliant foreign stablecoins here.
Okay, so Treasury could essentially put a foreign stablecoin on a kind of blacklist, making it really difficult, if not impossible, for people in the U.S. to trade it through regulated platforms. That sounds like a pretty strong lever.
It absolutely is, and there are penalties to back it up. For service providers here who knowingly violate that prohibition, fines up to $100,000 per day. For the foreign issuers themselves, if they knowingly keep offering their stablecoin in the U.S. after being designated non-compliant, fines up to a whopping $1 million per day. Treasury can also go to court to seek injunctions to stop the activity. Now, this definitely raises a practical question. How easy is it, really, to enforce a ban on secondary trading in a global market where peer-to-peer transfers can happen outside regulated exchanges? The Act's focus on demanding technological capability for compliance is interesting. It acknowledges the unique nature of digital assets. But the enforcement still seems to rely heavily on policing the traditional intermediaries, the choke points, #tag over waivers and exceptions, Section 8C. Recognizing that blanket bans might sometimes cause unintended problems, the Act does build in some important waivers and exceptions. The Treasury Secretary can grant waivers or licenses on a case-by-case basis.
For instance, if banning secondary trading of a particular foreign stablecoin might actually harm the U.S. financial system, or if the foreign issuer is actively working in good faith to fix its compliance issues. There's also a specific national security waiver. The Treasury Secretary, after consulting with the Director of National Intelligence and the Secretary of State, can waive the restrictions if it's deemed to be in the U.S. national security interest. And heads of intelligence or law enforcement agencies can also waive the restrictions if needed for their specific activities. These provisions provide necessary flexibility. They allow the U.S. to use discretion in critical situations where a strict ban might be counterproductive to broader strategic goals. #C. Registration and monitoring for permitted foreign issuers, Section 18. Okay, so that's how they restrict problematic foreign stablecoins. But what about legitimate ones? Is there a path for them to operate legally in the U.S.? Yes, there is. Section 18 lays out a detailed registration and monitoring process for foreign issuers who want to be permitted to operate here. They can actually be exempt from those prohibitions we just talked about, but only if they meet several strict conditions. 1. They have to be regulated by a foreign regulator that the U.S. Treasury determines provides comparable oversight to the U.S. regime. This comparability assessment specifically looks at whether the foreign rules match up to those stringent Section 4A requirements of the U.S. Act, reserves, transparency, etc. And getting this comparable status requires a unanimous recommendation from the Stablecoin Certification Review Committee and a published justification. Very high bar for equivalence. 2. They must register with the U.S. Controller of the Currency, OCC. 3. They generally need to hold reserves in a U.S. financial institution sufficient to cover liquidity needs for their U.S. customers, unless they're covered by a reciprocity agreement. And 4. Their home country can't be subject to comprehensive U.S. economic sanctions or designated as a primary money laundering concern. That registration process with the OCC is designed to be relatively efficient. Applications are deemed approved within 30 days, unless the OCC specifically rejects them, again preventing long delays. When reviewing, the OCC looks at the foreign issuer's financial and managerial resources for operating in the U.S., their ability to provide necessary information, potential risks to U.S. financial stability, and of course, illicit finance risks. And crucially, as part of registration, these foreign issuers must consent to U.S. jurisdiction for enforcement of this act. That's fundamental for accountability. The OCC, working with Treasury, can later rescind that registration if the issuer stops complying, maybe their reserves become insufficient, or they pose new illicit finance risks. Treasury with the OCC can also revoke registration if the issuer is caught facilitating sanctions evasion, money laundering, or other serious illicit finance activities. So it's a rigorous gatekeeping process for foreign players. #D. Reciprocity and bilateral agreements. Section 18D.
This sounds like a really forward-looking piece, acknowledging that, global finance needs global solutions. It seems like it's about building bridges with other countries that have strong rules, not just putting up walls, ensuring stability works across borders, and preventing companies from just moving to the place with the loosest rules.
Exactly. It's about international harmonization where possible. The Secretary of the Treasury is explicitly empowered to create reciprocal arrangements or bilateral agreements with foreign jurisdictions that have stablecoin regulatory regimes deemed comparable to the U.S. one. When considering these agreements, treasuries would look for things like, do they have similar robust reserve requirements like our Section 4A? Do they have adequate AML, counter-terrorist financing, and sanctions compliance? Do they have the supervisory and enforcement capacity to actually make their rules stick? These kinds of agreements aim to make international transactions smoother and improve interoperability, especially for U.S. dollar stablecoins issued overseas, fostering a more harmonized global approach where standards are high. It's an intelligent way to manage these global digital flows responsibly. #E AML innovation, Section 9. Finally, in this international context, the Act specifically pushes for AML innovation. It recognizes that financial crime in the digital world is constantly evolving and our tools need to evolve too.
So, it mandates the Treasury Department to actively seek public input and conduct research into innovative methods, techniques, or strategies for detecting illicit activity involving digital assets. Think things like using APIs for better data sharing, leveraging artificial intelligence, developing better digital identity solutions, using advanced blockchain monitoring tools. This research includes assessing where illicit activity is coming from, identifying gaps in current detection and methods, understanding the impact of different regulatory approaches, and pinpointing high-risk foreign jurisdictions.
Wow, so it's not just about applying the old anti-money laundering rules to new tech. It's actually mandating innovation in how we fight financial crime in this digital space. That feels genuinely proactive.
It absolutely is, and it directs action based on this research. Within 3 years, FinCEN, the Treasury's Financial Crimes Enforcement Network, is required to issue public guidance or even formal rulemaking. This guidance is expected to cover how to implement these innovative methods, set standards for stablecoin issuers on identifying and reporting various types of illicit activity, like fraud, cybercrime, money laundering, terrorism financing, sanctions evasion, even insider trading, and establish standards for monitoring transactions involving mixers, tumblers, or other privacy-enhancing services that can obscure fund flows. Crucially, it also includes developing tailored risk management standards for financial institutions when they interact with decentralized finance or DeFi protocols. This specifically acknowledges the unique challenges and risks in the DeFi space, where traditional AML controls might not easily map onto pseudonymous automated protocols. Treasury also has a report back to Congress on potential legislative or regulatory proposals coming out of this research, and specifically on the extent to which those blockchain mixers are actually facilitating illicit activity. So yeah, it mandates a forward-looking, technology-aware approach to combating financial crime. But it certainly raises an important question too. How will regulators navigate the inherent tension between the need for enhanced monitoring and legitimate privacy concerns, especially as some of these innovative tools touch on user data? It's going to be a delicate balancing act.
Okay, a really strong financial system isn't just about who issues the money, right? It's also critical how that money is held safely, what happens if an issuer or custodian goes bust, and how different parts of the system can actually work together smoothly. The Genius Act seems to tackle these vital points too, adding what sound like crucial layers of protection for you, the stablecoin holder.
Absolutely. These elements are designed to provide really important safeguards for both the users holding the stablecoins and for the stability of the wider financial system. The goal is to prevent catastrophic losses if something goes wrong, and also to make sure these new digital instruments can actually integrate effectively and reliably into the broader economy. It's about providing peace of mind. #TAG Custody of payment stablecoin reserves and private keys. Section 10. So Section 10 of the Act zooms in specifically on the custody, the safekeeping of both the payments stablecoin reserves and the private keys used to issue or manage the stablecoins themselves. It sets a clear rule. Only regulated entities are allowed to provide these critical custodial services. We're talking entities supervised by a federal primary regulator, like the Fed or OCC, another primary financial regulatory agency, a state bank supervisor, or a state credit union supervisor. This is a really critical gatekeeping function. It ensures that the companies holding these vital assets, the reserves backing the stablecoins, or the keys controlling them, are themselves subject to robust oversight, not just some unregulated startup somewhere.
Yeah, that sounds like a fundamental protection. Making sure my stablecoins or the reserves backing them aren't just sitting in some digital equivalent of a cardboard box in someone's garage.
Exactly. And crucially, the Act mandates how these custodians must treat customer property. That includes your stablecoins, your private keys if they hold them, any cash or other property. They must treat it as belonging to you, the customer, not as belonging to the custodian itself. This is the core principle of asset segregation, a cornerstone of traditional finance custody. Custodians also have to take appropriate steps to protect your property from their own creditors. So if the custodian gets into financial trouble, your assets should be shielded. Commingling, mixing customer property with the custodian's own funds is generally prohibited. Assets must be separately accounted for and segregated. Now, there are a few practical exceptions. For instance, commingling might be allowed in omnibus accounts at regulated banks, which is a common practice for convenience where one account holds funds for many clients, but with detailed internal records tracking ownership. Commingling might also be permitted temporarily for transaction settlement or under specific rules set by a primary federal regulator.
And insured banks holding cash reserves as deposits are permitted to do so under traditional banking rules, without the strictest segregation applying to those deposits. But here's a key protection for you as a stablecoin holder dealing with a custodian.
If that custodian becomes insolvent, your claims for the stablecoins they hold for you get priority over other claims against the custodian, unless you explicitly agreed otherwise. This directly imports strong consumer protection principles, like asset segregation and priority, from traditional finance into digital asset custody. It's designed specifically to ensure that if your custodian fails, your stablecoins aren't treated as part of their general assets available to all their creditors. ##B, Treatment Insolvency Proceedings, Section 11.
Okay, this sounds like a really critical section for anyone actually holding stablecoins. What happens if the company that issued the stablecoin goes bankrupt? This has been a huge source of fear and actual loss in the crypto world historically. Does the Act provide a clear answer?
It does, and this is arguably one of the most groundbreaking and user-protective aspects of the entire Act. It directly tackles that huge risk. The rule is clear. In any insolvency proceeding, federal or state bankruptcy involving a permitted stablecoin issuer, the claim of a person holding their stablecoin gets priority. Specifically, stablecoin holders have priority, on a pro rata basis, over the claims of the issuer itself and its other general creditors when it comes to accessing the required payment stablecoin reserves. This means stablecoin holders are first in line to get their money back from that dedicated, segregated pool of reserve assets. You get paid first from the backing assets. Furthermore, the Act clarifies things legally. For bankruptcy purposes, if you hold a payment stablecoin, you are explicitly deemed to hold a claim, which solidifies your standing in the proceedings. The Act even goes so far as to amend the U.S. Bankruptcy Code itself, specifically Section 362, the automatic stay. It creates an exception to the stay specifically for the redemption of payment stablecoins using those required reserves.
Whoa, wait. Does that mean stablecoin holders might actually get their money back faster in a bankruptcy than people usually do, avoiding getting stuck for years?
That certainly seems to be the intent. By carving out an exception to the automatic stay for redemptions from reserves, it aims to facilitate quicker payouts from that segregated pool, bypassing some of the typical delays and freezes common in complex bankruptcies. And the protection goes even further. What if, for some reason, the required reserves aren't enough to cover all outstanding stablecoins? Maybe the issuer failed to maintain them properly. In that scenario, any remaining claim that stablecoin holders have gets first priority over any other claim against the rest of the issuer's estate. That includes administrative expenses, other priority claims, first in line, period. This creates a powerful backstop, ensuring holders are prioritized even beyond the specific reserves if the issuer fell short of its obligations. The required reserves themselves are also generally excluded from the issuer's bankruptcy estate under Section 541B, reinforcing their protected status, although the automatic stay still initially applies to them. And regulators, like the OCC or the state regulator, are given the right to intervene directly in these bankruptcy cases to advocate for issues like customer protection.
So yes, it's a truly groundbreaking approach. It explicitly gives stablecoin holders this privileged, protected position in solvency, a level of security often totally absent in the unregulated crypto markets. It clearly defines these regulated stablecoins as a distinct asset class deserving special treatment in financial distress. The Act also mandates a study. Regulators need to look into potential insolvency scenarios, gaps in current bankruptcy law for stablecoins, the likelihood of holders getting paid in full, and whether specific orderly liquidation regimes might be useful. A report to Congress is due in 3 years, showing this is an area they intend to keep refining. ###taxi. Interoperability standards, Section 12.
Right, thinking about the future. If we want these digital currencies to become truly useful, like for everyday stuff, they really need to be able to talk to each other, don't they? Different stable coins from different issuers, running on different blockchains, interacting with different payment systems. It all needs to work together seamlessly, ideally. Does the Act address this need for interoperability?
It does, and this is a very forward-looking provision, anticipating the need for a connected ecosystem. Section 12 mandates that the primary federal payment stablecoin regulators, working in consultation with NIST, the National Institute of Standards and Technology, and other relevant standard-setting bodies, must assess the need for, and if necessary, actually prescribe interoperability standards for permitted payment stablecoin issuers. The explicit goal here is to promote compatibility and interoperability, not just between different permitted stablecoin issuers themselves, but also with the broader digital finance ecosystem. This could include standards related to accepted communication protocols or ensuring compatibility across different blockchains, whether they're permissioned corporate chains or open public ones. It acknowledges that the long-term utility and adoption of stablecoins really depend on a smooth, seamless user experience, and that requires technical interoperability under the hood. This provision could potentially drive the development and adoption of common technical standards across the industry, preventing a fragmented landscape where different stablecoins live in isolated silos
and ultimately fostering greater efficiency and usability for everyone.
Okay, we have covered a ton of ground today. From the nitty-gritty definitions to the strict rules on issuance and reserves, the dual regulation paths, the international aspects, and these crucial protections around custody and bankruptcy. Now, maybe let's just zoom out for a final look. What does this act, if passed, really clarify about where stablecoins fit into the bigger financial picture? And what does it signal about the future of digital money overall?
Yeah, if we connect all these dots, the Genius Act isn't just about regulating stablecoins in isolation. It's really about how our traditional financial system is grappling with, adapting to, and trying to integrate digital innovation in a responsible way. It's fundamentally about providing the regulatory certainty that many believe is needed to enable that integration and unlock responsible growth. It's drawing lines in the sand and trying to build a solid foundation. Hashtag A, clarifying. Stablecoins legal status, Section 17. And arguably one of the most impactful clarifications, a real cornerstone of the Act, is how it deals with the legal status of these specific stablecoins. Section 17 is pretty direct. It explicitly states that payment stablecoins issued by a permitted payment stablecoin issuer are not considered securities under a whole list of key federal securities laws. The Investment Advisors Act, the Investment Company Act, the Securities Act of 33, the Exchange Act of 34, even the Securities Investor Protection Act. Furthermore, they are also explicitly not considered commodities under the Commodity Exchange Act.
Wow. That is a huge statement for the industry. It basically settles, at least for these specific regulated stablecoins, years of debate and uncertainty about how to classify them. It's essentially saying, look, these things, under these rules, are intended to function as digital money, not as investment products like stocks or derivatives.
Exactly. And that clarity is potentially foundational for broader adoption and growth. It aims to significantly reduce the legal ambiguity that has honestly plagued much of the digital asset space for years. By clearly defining the regulatory lane for these payment stablecoins, separating them from securities and commodities, it could unlock much more participation from traditional institutions, from banks, from businesses who have been hesitant due to the legal risks. It gives them a much clearer green light, knowing they aren't accidentally stepping into the complex world of securities or commodities regulation when they handle these specific regulated stablecoins. Hashtag B, Authority of Banking Institutions, Section 16.
And speaking of banks, this sounds like a pretty significant green light for them and other traditional financial institutions to get more involved, maybe even directly, in the stablecoin space. It seems to remove some major potential roadblocks, especially around accounting and capital requirements that might have held them back before.
Absolutely. Section 16 explicitly affirms the existing authority of these institutions. It states clearly that nothing in this act limits the power of depository institutions, credit unions, national banks, or trust companies to do things like accept deposits or shares and then issue digital assets that represent those deposits or shares, sometimes called tokenized deposits. Use distributed ledger technology for their own internal record keeping or for transfers within the bank, or provide custodial services for permanent stablecoins, private keys, or the reserves backing them. This is a crucial confirmation, basically saying, yes, these activities generally fit within your existing powers. Furthermore, the Act actually mandates the primary federal regulators to go back and review, and if necessary, amend their existing guidance and regulations to make it crystal clear that the entities they supervise are authorized to engage in these stablecoin-related activities and investments. It pushes them to remove any lingering ambiguity. And on the custody side, the Act provides really significant relief, especially regarding accounting treatment.
It says regulators cannot require a bank or other institution to include digital assets they hold purely in custody for customers, assets they don't own themselves as a liability on their own financial statements or balance sheets. Nor can regulators require them to hold regulatory capital against those custody digital assets or their backing reserves, except maybe for capital needed to cover the operational risks inherent in providing custody services. This is a potential game changer. It removes a major accounting and capital burden that could have made offering crypto custody services uneconomical for many traditional institutions. Additionally, it clarifies that state-chartered banks with permitted stablecoin issuer subsidiaries can generally offer money transmission or custody services across state lines, provided their home state ensures they have adequate liquidity and capital, further enabling their participation. It's a comprehensive package to integrate them more fully. Hashtag JC, Studies on Non-Payment Stablecoins, Section 14. Now, while the Act itself is laser-focused on payment stablecoins, those backed 1.1 by safe assets, it does acknowledge that there's a wider world of stablecoins out there.
Section 14 mandates the Treasury Secretary, working together with all the key financial regulators, Fed, OCC, FDIC, SEC, CFTC to conduct a specific study focused on non-payment stablecoins. And it specifically calls out endogenously collateralized ones for examination.
Endogenously collateralized. Okay, that term again. Can you remind us what those are and why they warrant a separate study?
Sure. It's a bit technical, but basically an endogenously collateralized payment stablecoin, as defined here, is one that tries to maintain its fixed price, say $1, by relying solely on another digital asset that was created or is maintained by the same originator or group. Think of a stablecoin whose stability depends only on the value of another crypto token from the very same project, often involving complex algorithms, rather than being backed by external traditional assets like actual dollars or treasuries held in reserve. These types, historically, have proven to be much higher risk and more prone to sudden collapse, especially when markets get volatile. We've seen major failures here. So this mandated study will look into different categories of these non-payment stablecoins, their design features, benefits and risks, who uses them, how they're used, what backs them, if anything, the algorithms involved, their governance, how they're marketed, and what disclosures consumers get. This really highlights that the Genius Act itself is deliberately narrow, focusing only on the payment stablecoins it defines.
But it simultaneously signals that regulators are actively turning their attention to these other, often more complex and potentially riskier types, likely with an eye toward future regulatory action. They haven't forgotten about them. #TAG Annual reporting on the stablecoin industry, Section 15.
And it sounds like they plan to keep watching the whole space closely, even after this act is in place. This ensures ongoing monitoring and adaptation. It's not like a one-time fix, then everyone forgets about it. It feels like a commitment to continuously understand and manage this market as it evolves, which is crucial given how fast things change in tech and finance.
It's exactly right. Continuous oversight is built in. Section 15 requires the primary federal payment stablecoin regulators, working with their state counterparts, to submit annual reports to Congress and also to the Office of Financial Research, OFR. These reports have to detail current trends in stablecoin activities, give a summary of applications received, approved, and rejected, and critically describe any potential risks to financial stability emerging from the stablecoin market. The Financial Stability Oversight Council, FSOC, the Super Committee of Regulators tasked with monitoring systemic risk, will then incorporate these findings into its own annual report. This ensures that the big picture, the potential system-wide implications of the stablecoin industry, are continuously assessed and discussed at the highest levels of financial regulation. It creates a formal feedback loop to keep policymakers informed and allow for adaptive regulation over time. #TAG E-rulemaking and effective date, Section 1320. And finally, the Act provides important clarity on when all of this actually happens, the implementation timeline.
Section 13 mandates that all the relevant regulators, federal and state, must get busy and actually promulgate the specific regulations needed to implement this act within 1 year of it being enacted. It also strongly encourages them to coordinate with each other during this rulemaking process. And the act itself, including all its rules and amendments, will officially take effect on the earlier of two dates, either 18 months after the act is signed into law, or 120 days after the final implementing regulations are officially issued by the regulators. This provides a clear time frame. It gives regulators a deadline to get the detailed rules written, and it gives the industry a predictable window to understand those rules and prepare for the new framework to come into force. It brings a much-needed sense of certainty to the transition.
Wow, what a journey through the Genius Act. We really covered a lot of ground today, digging into the details of this proposed legislation. It truly represents a huge step, doesn't it? Trying to establish a clear regulatory home for payment stablecoins, sorting out roles for federal and state oversight, demanding those strong reserve requirements and transparency, and putting in place serious measures against financial crime. Plus, clarifying that crucial legal status, separating these regulated stablecoins from securities, and tackling vital issues like custody and what happens if an issuer fails. This entire deep dive, really, was about helping you understand what this could mean for the future of digital money. It's about how consumer protection is trying to be built into this new digital landscape, and what it signals for financial stability as technology keeps racing forward. It feels like a serious attempt to bring order, build trust, and maybe move stablecoins from the kind of wilder edges of finance into a more integrated, reliable part of our overall system. So as we wrap up, here's something to think about. The Genius Act is clearly a major move towards integrating these digital assets into our traditional financial world. It could definitely pave the way for wider use, more trust. But as we regulate and define the specific type of digital money, what kind of new innovations might spring up in response? Maybe things designed to work around these rules, or maybe entirely new forms of digital value. Will this framework ultimately speed up the shift to mainstream digital payments, or could it unintentionally create new hurdles or slow down certain kinds of innovation? And maybe the biggest question, what could this new framework, this attempt to define and regulate digital dollars, mean for the future of payments, for traditional finance, and maybe even for the very definition of money itself in our increasingly digital economy? Definitely keep an eye on how these regulations get finalized and rolled out and how the stablecoin market reacts. We certainly will be. Thank you so much for joining us on this deep dive. We look forward to exploring more fascinating topics with you next time.